Good afternoon, everyone. Thank you for being here for the final panel of the day. It's a tough spot right before drinks, so hopefully you have a little more patience to hear about the most exciting topic, which is utility. We were already talking backstage about where I think all the panelists see the real utility for real-world assets. But I'm curious, as a reporter covering the space, it seemed like last year the buzzword was stablecoins, and more stablecoins. Is that still going to be the main RWA, the main source of utility this coming year, or are you seeing it coming from somewhere else? And maybe I can start right here to my right. David.
Awesome. Excited for the chat. I think stablecoins are definitely going through their mainstream moment, and we are going to continue to see a lot of very interesting developments happening in that space. Stablecoins are probably, they're already massive, and I think you can argue they're one of the perhaps top 2 crypto applications, right? You have Bitcoin as digital gold, and then stablecoins pretty much there. So very clear product market fit, and we're very likely to see some sort of regulatory unlock over the upcoming months. I think that as part of this better regulatory environment that we're going to see in the industry, stablecoin legislation is probably the lowest hanging fruit. So the environment for stablecoins is extremely positive. Having that said, I do think we're going to see some other interesting initiatives. There's Superstate, and there's just a bunch of very interesting things happening in the industry. And it looks like probably yield-bearing tokens is probably the next thing that I would say is already taking off. But I think we've got clear a few roadblocks, we can probably see these things going a lot further.
Yeah, I think if stablecoins are the only successful RWA, we kind of failed altogether here because we want to bring more utility than the payment side only. So I think stablecoins need to grow along with what we're doing here because people got to pay somehow, and we're hopefully not waiting for SWIFT wire transfers to clear RWA. But I certainly hope, and I think there's living proof here with some of the panelists that we're beyond that first step, but a very important step that I think is going to follow us along this route. So hopefully both of them go over billions and trillions because people still need to go in and out of assets using stablecoins. But yeah, to David's point, we hope to see not only money market funds, but other many interesting assets on-chain being traded against and with stablecoins.
Well, I have some good news and some bad news. The good news is I think new asset classes that are not stablecoins are going to be growing at a faster rate. I think, there's a likelihood that over the next year, tokenized treasuries and new tokenized assets are growing at, 1,000% annualized growth. And stablecoins will be a lot less than that. They'll be 100% annualized growth potentially. But even if that occurs, and this is the bad news, that means that we're going to add like $200 billion of stablecoins, and we're only going to add a couple $1 billion of other assets. And it means that stablecoins are going to continue to dominate the narrative, even a year forward from now. In the same way that we've come a long way in crypto, but Bitcoin still dominates the narrative year after year.
And I would just add to that, and I agree with David too, I think it is an easy use case also for mainstream adoption to wrap their head around in terms of fiat, payments, you start to think about money movement, but I do think more sophisticated investors are interested in yield-bearing coins and also tokenized treasuries and some of the use cases we're going to talk about today. But I do think it'll continue to dominate the narrative. Even to Robert's point though, we're going to see significant amounts of growth as more and more institutional players come on, but I think also as more mainstream adoption through different apps also starts to grow.
So I'm curious, and David, I know that you mentioned the regulatory unlock of the bill. It seems like the main roadblock for stablecoins has been this fact that they've grown so much, but there still is no way for investors or holders, at least in the US, to enjoy some of the yield that companies like Circle and Tether are getting. And it seems like from the bills that are currently circulating or passing through the House and the Senate, there still is not necessarily going to be clarity around whether the stablecoins that will be approved will be yield-bearing. But of course, it seems like from all of your answers, you're expecting that to happen. And again, maybe starting from a US perspective, I'm curious if you're assuming that we are going to start having yield-bearing stablecoins maybe within the next year, or if you think that notion of yield is going to have to come from other types of assets. And feel free to jump in, or we can go down. But if anybody has strong thoughts on this.
Yeah, I don't think there's any lawyers here, but it's unlikely that we're gonna get yield stablecoins to be approved under not only in the U.S. but MiCA frameworks and others where they're going to allow you to offer under the requirements of a payment asset just yields in whatever shape or form. But I think back to my point, stablecoins already enable this kind of on-off ramp to the unregulated side of things, which grew a lot. Probably because it's unregulated to a certain extent, but could also be a good component on the regulated side as it comes on chain. So, yeah, I think the idea, and I heard this analogy, I don't recall if it was Ondo talking about checking account and saving account. So I think everybody here certainly has a non-custodial wallet, and you certainly has like your checking balance, which is your USDC or USDT. How easily are we going to enable that analogy from moving from your payment asset to your yield asset? Or even better, can you use your yield asset as your payment asset? And that maybe goes back to your question. I think in certain use cases, yes, money market funds are going to become just as easy to exchange as stablecoins for some specific routes of payments, and to one particular use case that I love, and I think it's great that David is here, which is the collateralization of money market fund on chain and what that unlocks from a margin and future trading perspective.
I would just add, though, before we go to the collateral use case, too, that is something that we've worked on in terms of a money market fund being tied to a Visa card that then you can pay off of. And so that is an example of where instead of using stable coins or fiat, you're actually earning yield up until the moment of payment. That's a huge also unlock for the retail investor. Then on the institutional side, obviously collateral and other use cases are big, too. But to answer your question directly, I don't see it being yield-bearing, but then that's also very different than the EU regulations of MiCA and the differences between e-money versus yield-bearing coins. So I think there's also a difference even internationally between where we're seeing regulation, which is going to be interesting as you start to see stable coins based out of the US versus out of Europe and how they're used. But I think at least for now, money market funds and also tokenized treasuries broadly, as we start to see rate shift, are going to be a big part of this narrative and a big part especially for retail use cases that will be interesting.
Yeah, no, I think it's interesting because we have a few use cases that were typically associated with cash, right? So like payments. Yeah? And then I think it is pretty fair to assume that I think stablecoins will, especially for payment purposes, at least in the short term, I think I would assume that those would be non-yield bearing, just the regular type of stablecoins we have. There are other parts, especially in the crypto ecosystem, though, that I think it's kind of a little bit the other way around. So for context, we're a prime broker in the crypto space. So we provide trade execution, credit, custody, and these types of services for institutions. And we are active in the both spot and derivatives markets. But in crypto, if you want to start, in any market, if you want to start a derivatives contract, you need to post collateral. In traditional markets, let's say if you want to trade in the CME, this collateral is not going to come in the form of dollars. It's going to come in the form of treasuries because you're going to get that yield and that positive carry that can make a massive difference depending on the trade strategy that you have. In crypto, it's actually a little different and less efficient, which is kind of surprising that we come this far and we still have this level of inefficiency in derivatives collateral pledging in crypto. Just for a little bit of history, and I'm sure many know this, but in the earlier days, it even used to be a little worse. I think a lot of crypto derivatives contracts, they used to be collateralized in Bitcoin, right? Then we went from Bitcoin to stablecoins, which is an improvement because you kind of get like, you get just like better risk management there if you're quoted in US dollars. And now, perhaps the next step here would be to start accepting money market funds or tokenized treasuries or some sort of yield-bearing collateral for these, at least initially, crypto derivatives contracts, right? This is a big market. We're just talking on the back. If you add the open interest for just probably the third largest assets, Bitcoin, Ethereum, Solana, and if you look into open interest for futures and options, you're probably talking about $100 billion or more. So there's a fair amount of stablecoins that is actually used to collateralize these perpetual contracts futures markets and things like that. And I feel like it makes a lot of sense for us to move from non-yield bearing to yield bearing. Of course, there's some regulatory unlock and clarity that needs to happen, but I think that's kind of how I see it.
I mean, just to add on to this, David, Superstate's USTB, which is our tokenized T-bill fund, is supported collateral at FalconX. So you can use it for collateral against derivatives transactions, and it's much more capital efficient for somebody who would like to do a trade.
So why hasn't that been widely adopted yet? What are the main roadblocks there?
Well, I think the main roadblocks are that the total number of investors that are even participating in tokenized, money market funds or tokenized T-bills or whatever is extremely limited, right? It's closely approximated to like a subset of the customer base of a FalconX or of a Galaxy or of any of these other platforms. And so it's still an incredibly nascent market. I mean, there's like, for these products, in some cases, there's like 50 holders, right? And markets form over time, and they form slowly, and they form, as network effects begin to take hold. And so what we're seeing is this like beginning of the ascendance of usage and integrations here, and it's going to continue to accelerate, but we're starting off from a point that's like, the bottom of the first inning.
100%. I think there might be some small, perhaps regulatory unlocks that we might be able to see. One important thing is that tokenized money market funds and tokenized treasuries, and I'm not a lawyer, not giving any advice, but I think it's safe to say that they're likely to be securities.
Sounds like advice to me.
For example, you take like our role, right? The role is of a dealer. If an investor comes to us and he pledges, let's say, Superstate's amazing product as collateral, we have to circulate that within the ecosystem for our hedging purposes, right? So, and today that ecosystem is still a little bit lacking. Part of it is because a lot of these things are securities. So for example, crypto exchanges don't want to touch on securities. So I feel like as we get some regulatory clarity, you have this unlock and these assets will start to circulate more in the crypto institutional infrastructure. And that will be like a massive unlock for this, because it might not sound a lot like, oh, you're going to get 4% or 4% and change credit, but this can be a massive difference for certain types of strategies. It's the difference between certain strategies being feasible or not feasible. So it's kind of, it might not sound like a lot, but it's a very big deal.
Are you seeing a change in the profile of investors who are coming onto the platform for either of you, or I guess more relevant to these three panelists here, but I'm curious if it remains to be a use case mainly used by a crypto native audience, or if you're starting to see institutional investors from outside of crypto, more traditional hedge funds or other types of trading institutions coming into the space?
I would say for us, so we have an institutional platform, WisdomTree Connect, that actually has attracted a lot of CFOs that are interested in this space for some of the reasons that David mentioned too, from a money market fund perspective, not only the yield, but it's also T+0. So in terms of cash management and treasury management, they've actually seen that to be very beneficial for them, and also just understanding and managing their books. So I do think that there are some, but to your point, those are still investors who are very crypto savvy, I'll say, to a point of they understand the infrastructure, they understand the benefits, they understand the utility, and even for where we were just speaking about, it's explaining to investors those unlocks in a way that they still do need to go to a new infrastructure, they still do need to set up a wallet, they need to be comfortable with that and what that means. So I still think for the majority of investors, it's still a little bit unknown, but as more and more players come on, I think there's a comfortability, especially with more regulated institutions participating and offering these services, that will see the demand grow.
Totally agree.
And I would add that, being on Stellar, we kind of try to help all the profiles here in the room, because we're on the foundation, so we don't compete at all with any of those value propositions. And I think one thing we need to do together, and I think a lot of people in this room, is regarding pushing the value of this use case forward. Because if you think that it's a T+1 to T+3 use case just by parking the money market fund as collateral, and also that in most cases you don't have daily yield to those assets. I talked to another issuer, which is not the two of you guys, and they were saying how they're knocking on the door of family offices and hedge funds that have some exposure to crypto, so they're to a certain extent familiar, but maybe not crypto only. And hey, if you have working capital or dry powder that you have to park somewhere, why not use money market fund and make your value chain faster? So it's something we need to work together and to a certain extent even challenge the value of what we're saying, but it has to come across. So I think if there's more clients knocking on your door saying we want to use that, then maybe that workaround in the ecosystem you just referred is going to become more tempting to you because then it's more money on the table, right? So I think we're trying to close that loop because it is much better, in my opinion, than holding stablecoins or Bitcoin as collateral, because only from an LTV perspective, I think also unlocks more line on your side, right?
100%.
So we've gotten pretty deep into the world of institutional trading. Maredith, you did touch on the distant world of retail customers and the myth of the actual person using crypto that's not just trading fart coin on Coinbase or something. And I am curious, I know several of you are more on the institutional side, but do you still think that we can have some sort of utility that will bring in everyday people and retail traders? Or is it just getting more and more into the institutional world?
So I think right now, and I think to Robert's point too, a lot of it is institutional at this point. But I think what we've built, and this was on purpose, was that from an institutional perspective, it is very crypto native. So you need to manage your own wallet. These are tokens that you need to understand how what gas fees are, how to actually do transactions. While on the retail side, our app WisdomTree Prime, it's a mobile app, and you would have no idea that you're on blockchain. It's just you can buy gold 24/7. 365, it's built on Stellar, and the transaction is settling in less than 30 seconds. It's just an easier way to transact and to hold if you want gold exposure or a money market fund or Bitcoin or Ether, and that's what that Visa card is tied to for the money market fund, so that you don't have dead cash sitting in a checking account, not earning anything, you're earning a yield consistently. But I will say that that narrative around that it's built on blockchain to the end retail investor, sometimes it resonates, especially if they're crypto curious, but for a lot of our investors, they're just interested in a better app and one that they can buy all their assets and they don't have to have 5 different apps to manage their daily financial life. So I will say that the narrative and actually just the storyline is very, very different, whether you're talking about retail investors or institutional investors, and there's very different utility for what this same token can do. So when I talk about a money market fund being used via a debit card for me, a retail investor, that's the same money market fund that could be used in the example that David gave on FalconX. It doesn't necessarily have to be a different product or availability, but the use of it and the utility of it is very different, and I think that's actually what makes this technology so powerful, is that you're talking about the same token, but it can be used in very different ways for very different investors, as long as, of course, the risk framework is right. And again, not a lawyer, but all the risk tolerances are met.
I mean, I'll go back to David's not a lawyer stuff from before, where he said 2 things. One, he said this stuff is securities, which is true, and he also said
advice.
That, yeah, not advice, but it is. Okay, and also that we're starting to see a major legislative and regulatory shift in the U.S. And so the combination of this stuff is securities and the prior 4 years under Gary Gensler, it meant that retail wasn't trading tokenized securities. They weren't holding them. They were walled off from it. I mean, it was basically just like a no-go zone. And that is changing. I think, within 18 months, we're going to see retail's interactions with this stuff go from basically non-existent to significant. And we still haven't seen it yet, but this is one of these things where we're going to see it in the short to medium term. This is not something we're going to have to wait a very long time for.
And some food for thought, things that we've seen on the Stellar ecosystem that I think are not ready yet, but are interesting gray zones to explore, not from a regulatory, well, maybe from a regulatory perspective as well, but gray zone in the sense that it's still early days, is using yield assets as trading pairs or staking assets on DeFi. So we sometimes use different terminology for almost the exact same use case because there's a lot of like yield farming or staking, which is just a way for you to hold something that is yielding interest and also trade in the same on the same asset, and that's margin trading or collateralization, just put it in different terms. But you're stuck with other risks, right? Like the native asset risk or the node risk or whatever. So if there is a situation where a money market fund could be put as liquidity on Uniswap or used as a collateral for a DAO protocol, you're actually now holding a very secure asset that's yielding you 5-4%, whatever the underlying asset is, and you're still doing whatever funny things you were doing on DeFi before. So that's one use case. And the other one, which is very near and dear to Stellar, is remittances. So we sometimes don't know, and maybe for the fact that it's not reported, how much cross-border and not only humanitarian, but just family remittances are going out of the US and other countries using not only Bitcoin, but stablecoins, right? And to a certain extent, the receiving side needs to have some sort of knowledge because they're getting a stablecoin and not cash out of a mom-and-pop store. But if they could get something that is easily convertible to local currency and would still earn some yield, you're doing also, to a certain extent, a social benefit here, right? Because they're making more money out of that hard-earned pay. So I think those are two interesting use cases that could benefit from our creativity here, both on the product design and hopefully, to Robert's point on the regulatory standpoint, that we can be more friendly to retail users and vice versa.
Agree 100%. The one thing I want to add, and this is going a slightly different vein, but I'm very interested in, this is probably a longer term thing, but I'm very interested in, and maybe you guys here will have opinions too, in seeing this movement of crypto exchanges started to get into different asset classes, right? So like Kraken did an important acquisition. Coinbase has been talking about like getting into stocks and things like that. I feel like at some point tokenized stocks is going to be a thing. There's definitely a road to go here, but some of these things perhaps could be also products that retail will be facing on a regular basis.
That was actually exactly my next question, which is what are those tokenized securities going to be? And I guess the underlying question for that is if you're an average retail trader and you have a Robinhood account, you're buying your NVIDIA stock or your Apple stock, what really is the utility of doing a tokenized version of that? I mean, Maredith, you say that for a lot of users, they might not even know that it's blockchain. Maybe the added benefit, it's a little faster, maybe a little cheaper, but what do you think those tokenized assets will look like for a retail audience in the near future?
So we have a real example, and I just realized David and I are both from Brazil. We got an exchange out of Brazil, which is really kind of an OG in this space called Mercado Bitcoin. And I just realized on RWA.xyz, I'm sorry, I'm referring them in this event, but just for the sake of curiosity, that they are placed fourth in private credit on chain. And I'm a client, so to the extent that I know, the user doesn't even know that it's a tokenized security in the sense that they are putting traditional assets on the shelf. So you got Bitcoin, you got whatever meme coin, and then they have some sort of like leasing, private credit, and some honestly products that they only exist in Brazil, like Precatório and others. But that said, those are non-crypto assets being offered through a crypto wallet because people are just used to invest and they can do PIX on-off ramping, which is something that I think it's getting to the US with FedNow and Europe with SEPA. So that easy experience of getting cash in and out, but also using the same app because at the end of the day, we're all lazy. So if in a single app we can trade.
Speak for yourself.
Yeah, sorry, some of us. I love switching between apps and clearing to get done. But anyways, so I think there's a good concrete example there. And to the point of regulations and crypto exchanges becoming security exchanges and vice versa, I think we're seeing that already. And it's an exciting path because then we're going to see them competing for being the most convenient place for you to invest your money. So if it's either Revolut or Nubank with a crypto tab, or if it's Coinbase with the security tab, who knows who's going to win. But the idea is that as an end user, it doesn't really matter. It has to be a convenient place offering good products and the fact they keep it on chain to the extent of my knowledge with Mercado Bitcoin is just cheaper. for them to manage back office. They already have a crypto back office anyway, so.
Yeah, I'm happy to add too. I think, I mean, we obviously have funds, and that's our history as an asset manager, but we've seen a lot in terms of tokenized stocks. And I think it was even today, I think it might have been Kraken came out about offering US stocks to the UK market. So I think that's also an interesting parallel too, where instead of having ADRs or some other wrapper that's offering these to different jurisdictions, there's also now direct access in a different way. So I think there's an endless amount of possibilities of what it could be like and what products are put out, but I do think that it's dependent on demand, it's dependent on the venue, to your point around exchanges, and then in terms of the retail investor, what that experience is gonna look like.
So it's the end of the day. I think we can have a fun conversation up here. How's everyone feeling about Trump?
The crypto asset Trump?
Yes, how's everybody feeling about the Trump meme coin?
Sounds like it's up today.
And you know, before I ask this in seriousness because it does seem like the past 5 months we've had this whiplash where, of course, he's managed to accomplish so much that he promised during the campaign, more than maybe in any other sector that he appealed to, from the Bitcoin reserve to obviously legislation moving forward in Congress. But obviously there's so much economic volatility right now. And I talk with VCs and traders and different people in crypto who are still somewhat befuddled that Bitcoin is performing and all the other assets are performing as they are. So, you know, I do want to ask in all seriousness, how are we all feeling about the markets and Trump right now?
I can start.
Thank you.
Go for it.
So the first thing I would say is the market is in a very interesting moment right now. Maybe some folks here will agree, but I don't think I've seen a bigger disconnect between retail and institutional as it pertains to crypto in a long while. So there's a very big disconnect here in terms of audience. I think there's also a big disconnect in terms of time frames. We obviously see a fair amount of flow at our desks, and it was interesting because everybody knew that a lot of these things were going to happen at some point, but I think a lot of crypto investors, they were heavily exposed to the asset class. And we started to see all these measures and the trade tariff and those discussions. Everybody was expecting some of that to happen at some point, but I feel like the surprise was that it happened much sooner and at a much greater magnitude than everybody was expecting to see. So I honestly actually wrote this at the end of the year. I always look at the correlation between Bitcoin and risk assets, and after Trump's election, we started to see that correlation go down significantly. And that makes sense, right? Because then you have these industry-specific factors being a bigger driver of price action. And I was actually expecting that to happen for a long time. Turns out that come Liberation Day and perhaps even somewhat before, you had all these macro factors and macro certainty taking the front seat again and basically just driving the bus for everything that's going in the market. But the thing I see, I mean, when we talk to our clients is that a lot of folks are very excited about the industry when they take a 6, 12, maybe 18-month view forward, definitely on the Bitcoin side. And then if you go far enough, there's a lot of interesting things to be excited about on the crypto space more broadly. The issue is that in the short term, nobody knows what's going to happen. You have these economic uncertainty indices at like all-time highs or perhaps multi-decade highs. And I think that's kind of the issue. We're in a little bit of a disconnect between the short term and the long term.
Assuming you're not going to let anyone take a pass on this one, so I'll try to keep it short. I'll put it this way. I think we're happy to see regulators, not only in the U.S., but including the U.S., just making progress on regulating the underlying asset and the underlying use case and not the technology. And with that in perspective, we all need to do a good job to prove that the products and the use cases are are safe and sound, but that level of clarity just creates organic demand for exploration, because so far people knew about the value but was scared on the lack of clarity. And not to tie this to a particular person or in charge person, I would say that the same is happening in the EU as well, and the Middle East and other countries, where I think there is kind of, to a certain extent, a positive vibe on regulators kind of using this momentum to push things forward, and this, I think, it's very welcome. I think there's nothing worse than uncertainty from a regulatory perspective to prevent investors and developers to build stuff. It's better to have bad news than no news, and I think in this case, just because things are getting written and spoken, this is just helping the industry sort its way forward.
Well, I'll preface by saying I'm not a trader. I'm not really a markets guy. I like building technology, and so my views on this are probably wrong, and you should do the opposite of anything I say. But I think in general, this is a period where the world is questioning the existing monetary order. I think that's bad for a lot of asset classes like equities. I think it's bad for the dollar. I don't think it's bad for Bitcoin. Sadly, I think it's actually very good for Bitcoin. It's been very good for gold. I think there is a structural tailwind for a neutral currency more than there's ever been. And for the wrong reasons, I'm super bullish on Bitcoin during this administration. I don't know what that means for the rest of the crypto assets, but I've gotten personally very bullish on Bitcoin.
I'll go back to Rob's point around the regulatory framework. I mean, we have a suite of tokenized funds that are effective with the SEC because they're securities. Under the old administration, we also have a trust license, so that's a gold token, to Robert's point about inflation hedge and a stablecoin. So in this administration, I think there will be other developments like the stablecoin bill that we're hopeful will get passed and we'll have some more clarity. But I'd say too, around actually the crypto market, it continues to be very interesting, and also now more and more there's dislocation between the traditional markets, which I think also for retail investors in particular, it's an opportunity, while institutional investors, I don't know if people were taken by surprise, but I do think that there's still a lot of opportunity there. And we're very much in the first inning. I'd say even maybe we're at the start of the game, where we're finally getting to a point where all of us have products and the infrastructure and the technology to be able to really affect change. So I do think that it's a much longer road than over the next even 18 months that we'll see significant changes in this, just like we saw if you think of the advent of the internet or electronic trading. I mean, it's gonna take time, or even ETFs. It's gonna take time, and then we'll see that hockey stick of adoption. And gold, yes.
Well, I am curious about that dislocation, because I think, the first few days after Liberation Day and the tariff announcement, there was a lot of excitement on crypto Twitter that Bitcoin hadn't really dropped. And then I think over the weekend it did, and everybody was crestfallen. And now, it's sort of recovered. I don't know. I think there's always this open question whether Bitcoin will really be seen as this hedge and this independent currency, or if it's just basically the new risk-on strategy for global traders. And I mean, I am curious. And Robert, I know you said that you're not necessarily a markets guy, but do you still see that promise happening? Or maybe put it differently, are you worried that Bitcoin is just going to become another like TradFi asset class for hedge funds?
I don't think there's a difference between TradFi and DeFi. I think it's all finance at the end of the day. Most of the whole world runs on finance and capitalism. And so I don't think it's a problem if it's like, Bitcoin becomes a thing that the whole world uses as a means of trade, speculation, and economic activity. Like, I don't think it's a bad thing. I think it's probably sort of like closer to the end state.
Agree. I have a strong take on the Bitcoin risk asset, non-risk asset. I very much think that Bitcoin is a risk asset. And it's a risk asset because its use case, it hasn't gone through its full discovery, kind of utility discovery process. If Bitcoin were an asset that behaved exactly like gold or exactly like a safe haven asset, it wouldn't trade at the price that it trades now. The reason why Bitcoin is a small fraction of gold's market cap is because this potential is not yet fully realized. So I think it's totally fine for Bitcoin to be a risk asset in the short term, but in the long term, then we're going to see what happens. I think that Bitcoin has some very important intrinsic characteristic that will make it a gold or enhanced gold type of asset, but that is something that is only going to play out in the next many years, if not decade plus. What I think was interesting about this market reaction, and I think a lot of folks were talking about decoupling and like the break of correlations. I fully agree with you, Leo, that didn't happen much. You cannot look at one day and then just extrapolate it from there, right? It's not very statistically significant. Decoupling is mostly associated with like correlations breaking up. And we didn't see that. We saw that for only one day. But the thing we saw is that for the first time, we had a massive equity sell-off, and Bitcoin showed a beta lower than 1 behavior. So Bitcoin went down less than equities. And this is something that hasn't happened before. If you look at the other big equity sell-offs, you can look into the yen carry trade unwind in August 2024. You can look into the mid-sized banking crisis in the US in March 2023. Can go all the way back to the COVID crash in March 2020, Bitcoin always felt not more, multiples more than equities. A day in which the S&P is down 3 to 4% would typically mean that Bitcoin is down 12, 15, sometimes even 20%. This time, it was a little bit the opposite. And even if Bitcoin has been performing relatively poorly leading into the event, that has been the case in the past as well. So I think that's the interesting thing. Like, it sounds like that for the first time, there is a perhaps group of investors or a class of market participants that are realizing that Bitcoin is an asset that you might want to flock to. Again, it's not fully developed. It's just a glimpse of what the future will look like. And these are interesting kind of evidences to see that Bitcoin is growing up, that is starting to echo that vision that a lot of folks who are or who have been bullish about Bitcoin a long time, that Bitcoin is moving in that direction. And I think that was an important signal.
Okay, rapid fire, last question for all of you. I'm going to bookend it with the beginning where we said that maybe last year the big narrative was stablecoins. Before that you had ETFs, NFTs, et cetera, et cetera. What do you think the big narrative of this coming year is going to be? And if each of you could give just a nice quick answer on this one.
Can I go last?
And it can't be collateralization.
I'm pumped with the idea of gold access through wallets. Talked to Maredith a lot about that. And just more broadly, just bringing quality assets to emerging countries.
Mine is definitely identity. I think we haven't talked about that at all here, but I do think that identity on chain is something that's going to be actively worked on. I know we're working on it. Others in this room are. I think that's going to be a big one too, as you start to see investors truly participate in this market.
I'm biased. I think the answer to what is going to be the next theme is going to be Superstate.
I'm going to call a team that's, I don't think maybe 12 months out, but probably 24 months out, which is I think we're going to see a DeFi renaissance if we get the right regulatory environment, the DeFi 1.0 protocols, the compounds, and like all the DeFi is an interesting area in crypto because I feel like it has product market fit. It just got dived a little bit because of the regulatory unlock, because of the regulatory policy we had in the past. If we get a little bit off unlock, I think there's a very interesting product market fit. And I would even go far enough to say that part of the reason why RWAs are interesting is because they bring real-world assets to DeFi. And DeFi is like how perhaps a lot of our finance, plumbing, and infrastructure will be based upon in the next 5 to 10 years. So it's a longer-term view, but one I'm pretty confident in.
Just a quick note, I think that view is linked to the idea that maybe we don't even need to care about Bitcoin anymore, because Bitcoin is just one use case on blockchain, and we're talking about using blockchain for other use cases here, so DeFi is another one that hopefully would decouple, to your point.
All right, blockchain, not Bitcoin, is coming back. You heard it here first. Thank you. Thank you to all my terrific panelists here. Really appreciate the conversation, and I hope you all enjoy happy hour. Thanks a lot.